Hi, Steve Schlegel here. I want to help you understand how to read your financial statements in your business. And in order to do that, I want to start with the profit and loss statement. So you should pause this video right now and go print out a profit and loss statement. Okay? Now, once you've got that profit and loss statement, there's three key areas on it that I want you to think about. The first part is up at the top. It's the income section. It's the gross income, the money that customers are paying to you. The next section for most businesses is the cost of goods sold section. It represents all of the direct and indirect costs related to selling products or services to your customers. Those costs tend to be variable in nature, because if you don't sell anything, you don't generally incur those costs. And the third section, depending on the accounting system you're using, might just be called expenses or general and administrative. I know QuickBooks likes to call it expenses. I would just retitle it if it was me, and I would call it SG&A. That's an accounting term. It means selling, general, and administrative expenses. Selling, general, and administrative expenses are really those more or less fixed costs for running your business. It's important when you put your accounting information together to make sure that that chart of accounts represents reality. Cost of goods sold section, those costs that you have related to getting that product or service out to your customer. Remember, they tend to be variable in nature. For instance, direct labor or direct materials that go into whatever it is that you're selling. Whereas fixed costs, the general and administrative and selling costs, would be things like salesmen's salaries or commissions, administrative staff salaries, rent for the administrative offices, some benefit plans and so forth, insurance. Some of those types of expenses can belong both partially in cost of goods sold and partially in fixed. But in general, I want you to understand those three sections. And I want you to understand it for two reasons. One, the fixed cost section, if you think about it, those are the costs you have every month, whether you sell one product, 1,000,000 products, or none. And that means on the first day of the month, whatever your fixed costs are, let's say it's $20,000 a month, you start out $20,000 in the hole, and you have to sell enough to get back to break even. So obviously you'd want to keep your fixed costs as low as possible. So you're always scrutinizing your selling, general, administrative costs to keep that as small as possible. Then the upper section, where we're looking at sales and cost of goods sold, sales minus cost of goods sold gives you your gross margin or your gross profit. And what we're interested in there is not so much the exact dollar amount, but the percentage. And so when you look at your sales minus your variable costs, cost of goods sold, you might find your margin or your gross margin to be 40% or 30% or 70%, depends on the type of business that you have. But what's really neat is if you can improve that gross profit percentage, as soon as you've climbed back out of the hole and met those fixed costs, if your gross margin is 40%, for instance, that whole 40% on the next dollar of sales goes straight to the bottom line. So you're always trying to keep those selling, general, administrative costs as low as possible, and it should be a fixed number, not changing very much from month to month. And you're trying to maximize your gross profit percentage, or the corollary, minimizing your cost of goods sold percentage, so that you're driving more and more dollars to the bottom line. It's kind of a big picture way to look at it, and there's a lot more that goes into it. But start thinking about that, and then get some help to understand your specific statements and how you can improve your business by using this diagnostic tool called the profit and loss statement.